Today, we're talking mortgage rates in the fall of 2025. Let's get started. Hi, I'm Jeff Abel from Estes Park Living with Signature Home Team. Welcome back to the channel. And if you're new here, thanks for joining us. Here on the channel, we talk about all things real estate here in Estes Park and across northern Colorado. And we share what it's like to live in one of the most beautiful places on the planet. So today I'm here with Harriette Woodard with Bank of Colorado Mortgage, and we're going to answer some questions that you may have about mortgage rates and specifically how some of the Fed decisions affect that. So the first question is, the last couple Fed cuts we've seen, mortgage rates have actually increased. Is that normal, and is that something we should expect in the future?
Not really. Many people assume that when the Fed cuts the short-term rate, mortgage rates should fall. But the relationship is actually a little more indirect than that. It involves inflation expectations, the bond market, and investor philosophies. By the time the Fed actually cuts the rate, that move has already been built in and priced in. Investors have been trading for weeks, if not months, based on what they think the Fed is going to do. So when the cut actually happens, sometimes that will trigger a different response and rates can rise or stay flat. One of the best ways that I've heard this explained is that mortgage rates live in a different neighborhood than the Fed rate. So the Fed controls the overnight rate between banks, and mortgage rates live somewhere way down the block with long-term rates or long-term bonds. And they're more affected by inflation, government spending, investor confidence. So when the Fed cuts the rate, it doesn't directly affect mortgage rates, but it does affect the whole environment around them. So if the market believes that that rate cut came because inflation is cooling and the economy is softening, then rates will go down. But if there's fear that inflation is going to spike again or the government will continue spending, then that drives long-term yields up and mortgage rates with them. So the bottom line is that Fed rate cuts don't cause mortgage rates to rise. In fact, when you look at it over the long term, they tend to trend in the same direction. However, mortgage rates respond to expectations. So it's not really what the Fed does, it's what the market anticipates the Fed is going to do.
So essentially what I think you're saying is that mortgage rates dropped prior to the Fed in anticipation of what news we were going to get from the Fed, and then they correct as that information comes out based on what the Fed decided to do. Is that accurate?
That's exactly accurate. So it's telegraphed ahead of time, it's priced in ahead of time, and then what happens is when it actually does happen, the market doesn't react to the actual announcement. It reacts more to what they anticipate ongoing.
We've talked a little bit about the Fed rate. The government is concerned about mortgage rates, but it's not their highest priority probably with everything else going on in the economy, with inflation, with unemployment, and all of those things. What else can the government do to affect mortgage rates?
There's actually a number of levers that the government can pull that would have impact on rates. We've talked before about the spread in previous conversations. Yep. And that's the spread between the 10-year Treasury and the 30-year fixed rate. And historically, that spread should be 1.75 to 2 points. And recently, it's been 3 points. So if that alone would just normalize, we should see rates in the fives. So how can the government affect that or fix that? What they can do is support liquidity. So they can make it more attractive and easier for investors to buy mortgage-backed securities. And they can do that through incentives, through tax credits, or guarantees. Additionally, they can just buy mortgage-backed securities directly. And once you increase demand, then investors don't need as much of a cushion for them to bring down rates. The second thing they can do is to reduce uncertainty. If the government was just clear on their communication, didn't have any surprise regulations, and just kind of dialed down the market a little bit and made their policies predictable, then that would help investors feel secure and invest in mortgage-backed securities. Another thing that can be done is banking deregulation. So when they regulated banking after 2008, they made banks much more cautious about investing in mortgage assets. So what they could do is do targeted deregulation where it makes it more attractive for banks to invest in mortgage-backed security, doing the same thing. So when we reduce the spread and make investors feel more comfortable and secure in the market, that will bring rates down and they'll move on their own, irrespective of inflation and Fed cuts.
Again, what I'm kind of hearing is the government has some things they could be doing. Some of this is continued out of kind of the overcorrection maybe from 2008's crisis with regulation stuff, but the government has some things they could tweak to get that spread back down to kind of historical averages.
Exactly, and I think they are focused on that, and I think we will see that over the coming months.
Just a quick break to tell you that if you're enjoying this video, we would love for you to like and subscribe. It helps our channel grow, and make sure you get next week's video when it comes out. So be sure to do that below. Now back to Harriette. So as we look at the opportunities ahead for buyers right now, we know that buyers have been a little bit more cautious over the last several months, year plus. As we look at where we're headed this fall into winter, where are the opportunities for buyers, or should they just wait?
Yeah, it's interesting because if you're hearing constantly that rates are going to fall over the next year or 18 months, your first instinct would be, well, I should just wait. But the market doesn't wait. And interest rates aren't the only thing you should consider when buying real estate. What you need to do is time the market to your life. There's an old saying, when's the best time to buy a house? And it's yesterday. And even in times when people were told to wait, like in 2008 and early 2020, when things were so uncertain, that turned out to be wrong. If you invested then, it was a great opportunity and a great wealth builder. So the best time to buy is when people are hesitating. Real estate's a long-term play. Equity and appreciation always outweigh that short-term pain of the rate. And when rates start to come down, demand is just going to go up. And it's going to become very competitive. And if you wait for the perfect rate, you're probably going to end up paying more for the house. And you can always refinance, but you can't go back and buy the house for yesterday's price. So where's the opportunity right now? For buyers, it's getting ahead of the curve and purchase now, refinance later. For sellers, it's get in now while inventory is still relatively tight before it becomes more competitive. And for investors, it's invest in markets where rent is still strong and appreciation is predicted, like our market. And so you want to stay in it. Housing isn't just a financial transaction. It's a long-term wealth play. It's a hedge against inflation. And mostly it's your home. So should buyers wait? No. You should be getting prepared, get pre-approved, understand your numbers, and when the right home comes along, that's when you make your move.
Well, I think we can see this looking backwards, right? We don't know what the market's going to do moving forward, but we know looking back, when interest rates were really low, prices were sky high. And people were paying $75,000, $100,000 over asking because interest rates were so low. And that was a crazy time in real estate. Now you have an opportunity where inventory's up, rates are up a little bit, but within historical averages for what we've seen over the last 30 to 50 years. And there's room to negotiate right now if you're a buyer too. So a lot of times you can offset that interest rate that maybe you think is a little bit higher than you would like with a lower price. I think that's really great advice for anybody watching this. If you're thinking about buying, now is a good time. Just lots of things to consider and weigh. It's not just an interest rate and it's not just price. Anything else you want to share with them?
No, I think now's a great time. It's a great opportunity, and it's a long-term play.
Well, if you have some additional questions, I'm going to drop Harriette's contact information down below in the description, so feel free to reach out to her. She would love to talk more about mortgage rates and how she can help you if you're thinking about making a purchase. And as always, a reminder that Julie and I are real estate agents here in Colorado. And so if you're thinking about making a move or just have real estate related questions, we want to be a resource as well. So please reach out for that. Harriette, thanks for joining us here on the channel today. As always, great information, and we appreciate your being willing to come on.
Thank you for having me. Enjoy being here.
We'll be back next week with a new video. Until then, I'll see you around town. Hey, thanks for watching all the way to the end. I've handpicked a couple of other videos I think you'll like next. Start with this one over here or check out this one over here.